Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we have another webinar presentation from John Ehlers, the second that he's done for BMT, and this webinar is part of our 5-year anniversary on BMT. As such, we're going to be giving away 5 autographed copies of John's newest book titled Psychoanalytics for Traders. So you're going to want to pay close attention to what John has to say today. I do encourage you guys to take notes, as there will be a quiz at the end, and that will determine who the book winners are. Some of the bullet points that John's going to cover today include market data being fractal, spectral dilation, aliasing noise, removal of aliasing noise using a super smoother filter, mitigation of spectral dilation using a roofing filter, and evaluating trading system performance using Monte Carlo. So with that, before we get started, I want to remind everybody that as you guys have questions, you can type them into the questions box, although John has said that we're going to hold the questions until the end, so just take note of that. Also, the webinar is being recorded, and I'll post the recording on BMT and on our YouTube channel sometime tomorrow. If you guys are watching the recording at a later date, please do me a favor and give it a thumbs up if you like it. All right, and with that, I'm going to turn things over to John and let him do his introduction. All right, John, you should have control.
I have it now.
Yeah, so you can share your
hello,
screen.
everyone. Thank you for joining. I hope this is going to be exciting and interesting for you. And we have the usual caveats before we begin that the information in this webinar is for educational purposes only. And as you know, trading is risky and not everyone should do it. And for my full disclosure statement, please go to stockspotter.com/in/legal.aspx. So, I am John Ehlers. I'm an electrical engineer. I'm retired. I retired from Raytheon as a senior engineering fellow. I got my bachelor's and master's in electrical engineering at the University of Missouri, and I did my doctoral work at the George Washington University. And that has served me well because the fields and waves and information theory I've used in my own trading. I started trading in the mid-1970s when computerization was just starting to come about, and I joined in the leading edge of that wave. And among the things that I did was I adapted the geophysical algorithms searching for oil using the maximum entropy spectrum analysis, or MESA as I call it, adapted that for trading, and that's the cycles measuring technique that's been popular throughout the years. And as Mike said, my most recent book by John Wiley and Sons is Psychoanalytics for Traders. And that contains pretty much all my latest research, and I think it's a pretty cool book, but I'm a little biased. My current status, I'm a co-founder of stockspotter.com, and I'm also a principal of Mesa Vector Asset Management. In Mesa Vector, we trade 4 index futures accounts as managed accounts. So if you're interested in managed accounts, you might look that up. So what we're going to do today, as Mike said, last year I gave a webinar that was pretty much a theoretical webinar, and I talked about aliasing noise and how to get rid of that with the super smoother filter. The code for the super smoother filter is included in that webinar. I also talked about spectral dilation, and that comes about because the market is fractal, and how to filter that out and get a better perspective. I showed that waiting for confirmation of your overbought and oversold indicators really doesn't work, and the way to make it work is to change the algorithm around a little bit and anticipate the turning points. If you wait for confirmation, it's just way too late. So today I'm going to go beyond that. We'll do a review, but then I'm going to go on to some practical applications. I'm going to show you how I model the market as a deterministic sine wave. So my conviction is that if an indicator or trading system doesn't work on a known waveform, a theoretical waveform, it's sure not going to work on the real world waveforms of prices that you run into. So we're going to take this concept of anticipating turning points, and I'll show you how to combine a fast indicator with a more momentum-like indicator to get a consistent return. And by using this theoretical waveform, I can forecast prices 2 weeks into the future using daily data. Also, in the May issue of Stocks and Commodities, I wrote an article about how to create equity curves, because when your trading is parametrically described by profit factor and percent wins, and knowing that and a random selection of trades, you can create a random equity curve that simulates all the possible combinations that you might run into in the real world. From that, you quickly see that a equity curve is not the best of indicators for performance, and I'll show you a Monte Carlo and how we do it, and how you can get keys into improving your trading results. So let's jump into it with aliasing noise. Aliasing is a particular kind of noise. We're using sample data. That is, if we use daily data and on closes, we're taking one sample per day. And I don't care if you use high plus low plus close over 3, it's still one sample in the day. And when you sample like that, you're basically multiplying the frequency of the sample rate times the frequency components in the data. And so that's very similar to heterodyning in radio, which means you're going to get sidebands. And in the case of trading, the upper sideband is folded down into the baseband, and it overlays the noise right on the signals that you're trying to analyze. And the noise is highest near the sample rate and near the highest frequency that you can use to analyze. That's called a Nyquist frequency, and using daily data, that's a 2-day cycle. So as you get away from, and that because you've folded noise back down, it's just impossible to use the data for short cycles because this noise swamps the signal. In fact, it is larger than some of the real data that might be up around 10 or 20 bar cycles. So you have to get rid of it by filtering. You can't, you just can't use real short cycles because it's swamped, but you have to get rid of it anyway because it's stronger than the real data that you're trying to smooth out. So if you use a moving average, it really is not a very good filter, and you can see the curve in last year's webinar. And instead get a little sharper filtering response with minimum lag with the super smoother. And so that's one of the mandatory requirements of data processing. The data itself, the market data is statistically looks like pink noise or 1 over F noise. At an audio level, a white noise sounds like a hiss if you tune to a radio on a blank station. It's pretty bright and has that hissing sound. However, pink noise or 1 over F noise sounds more like rainfall. That is, you can hear those low frequency or long time between occurrences like individual raindrops seem to be louder. And so that at an audio level is what pink noise looks like. And that statistically is what market data looks like, with the result that market data are fractal. And as everybody knows, a 15-minute chart looks just like a daily chart if you ignore some of the quiet times overnight, or a daily chart looks like a weekly chart if you remove the all the labels. And that means that the cyclic components in the data are proportional to the time base. So that if you double the cycle period in the data, what you can expect to see is the swing amplitude of the cycles are going to correspondingly double. And this doubling, for you that are mathematically or engineering oriented, that goes up at the rate of 6 dB per octave. But the oscillators that we use, stochastics or CCIs or RSIs, these are first order filters. That is, they have one difference in them. And so they smooth out the data at the rate of 6 dB per octave also. So if the data is going up at 6 dB per octave and the filtering is knocking it down at 6 dB per octave, the end result is statistically you flattened the spectrum, but you haven't gotten rid of the undesired components. The result is that oscillators by themselves no longer do adequate filtering. So here's the solution. We use this roofing filter. The red dotted line below the bar chart shows a smoothed sample of the data that has gone through a first order high-pass filter also. And what you see is that long run-up of the prices is reflected in the movement of that dotted red curve off the center line. In other words, that long low-frequency component is still in the oscillator. You've not adequately gotten rid of it. So to get rid of it, we introduce a second order high-pass filter. It's still passing all of higher frequencies, but it's getting rid of the low frequencies, the long wave components. And what that does is it gives you the blue line that you see, with the resultant that it does two things. Number one, it restores a nominally zero mean to that blue line. It's going plus and minus about the center line with fair symmetry. And the second thing it does is it removes a lot of lag that was introduced by that long wave component. So the process is the roofing filter consists of a super smoother and a second order high pass filter. And the codes are in last year's webinar. You can do it yourself. So here's what happens in a regular indicator like a stochastic. The conventional stochastic, as you see here, is distorted. It doesn't have the nominal zero mean as you're going up. And that leads to all kinds of wild interpretations and rules associated with the uses of a stochastic. And frankly, most of them are just plain nonsense. Instead, if you precede the stochastic by a roofing filter, you knock out all that low frequency distortion, and you have a waveform that is swinging back and forth in a nice symmetrical manner with a zero mean. And so this is the kind of waveform that you want to have for swing trading. So when you're swing trading, the usual conventional wisdom has you waiting for confirmation, and this is the stochastic you just saw on the previous chart. And the rules are when that stochastic crosses over the 20% line, you buy, and when it crosses under the 80% line, you sell short. And that's conventional wisdom. So I did this. I went back in 10 years of the S&P futures, and I got this result, which is a dead loser. I didn't use anything except that rule. So something is desperately wrong with conventional wisdom. If we kind of look at the data from the 20,000 foot level, you can see that there's nominally a monthly cycle in there, and that kind of makes sense from a fundamental point of view because companies make their numbers by the month typically. So the kind of cycle activity that you're looking for in swing trading is a monthly cycle, more or less, and it consists of 10 bars up and 10 bars down. So here's what happens with our indicator. We going to introduce about 2 bars of lag with our roofing filter, and another 2 bars of lag with the stochastic. Then we get our signal. Then we have to get in the next bar after the signal. We can't have to wait till the close happens. And then additionally, we're going to wait for another 3 bars after that for confirmation, with the result that the lag in getting a buy signal or a sell signal is 8 bars after the turning point really occurred in the data. Well, if you're 8 bars into a 10 bar move, you've got a consistent loss, and that's why this is a consistent loss using conventional wisdom. So if we look at it from a slightly different point of view, and I've written other papers on this, if you think of a stochastic as a predictor of an oversold condition with reversion to the mean, then what you want to do is to anticipate that turning point. So instead of buying when you cross over the 20% line, you want to buy when you're crossing under the 20% line. That anticipates the turning point by several bars. Correspondingly, you want to sell short when you cross over the 80% line. So using that set of rules and nothing more, I went back to the same 10 years of the S&P futures and got this result. Bingo. Now, the reason that it works is we still have the 2 bars of lag for our roofing filter. We still have the 2 bars of lag using the stochastic. We still have to wait 1 bar after our signal to get in on the next open, but we can subtract out 3 bars of lag because we're anticipating that turning point. The resultant is we have only a net 2 bars of lag with respect to the real turning point in prices, and so we're only 2 bars into a 10 bar move, and we get a consistent winner. So that's the theory of it. And so we're anticipating the turning point to make our entry. Here is real life. Now, my philosophy is that we have to have our indicators and trading systems work on deterministic and theoretical waveforms, or they're sure not going to work in the real world. And so what I have done in the StockSpotter website, I've created an indicator with a false ticker symbol, SINE, to be a sine wave. And what this sine is a 20 bar cycle. It's centered at a value of 40 and swings plus or minus 2 from that nominal center. So what we have here, whoa, I'm sorry, I got lost. Let me go back, page up. I'm back again. Sorry about that. I bumped something. The blue line here is a momentum indicator, very similar to a stochastic. It has the lag that you would have in a stochastic, and is showing basically the momentum of this theoretical sine wave. In addition to that, I have a bandpass filter essentially that has an anticipatory lead to it relative to the real price in the data itself. So what we have is a combination of indicators that are designed to eliminate the false bad signals, but still provide us with a leading indication. And what we're doing here is we have a trade setup indicated by this triangle before the bottom of the sine wave, and it happens when our bandpass filter reaches a cycle trough and the momentum is declining, or parenthetically is at a minimum. Those two conditions together clean up the entry signals from what I showed you on the previous charts. And that creates a trade setup. The trade setup, we can take a trade up to 3 days later because we're anticipating a turning point. And here is every one of our theoretical buys are dead nuts on, and we exit on another exit rule. So what we have on this chart are those setups, but more than that, because I have this theoretical waveform and I'm measuring the cycle, I can predict the continuation of that cycle into the future. I mean, it's indicated by this purple swoosh. This is not a Mickey Mouse extension of a linear regression line. This is a real projection of the anticipated prices. And so we use that to great effectiveness at StockSpotter. Also at the bottom of the chart, this yellow line means that the market is going sideways. If it were in an uptrend, it would be green. If we were in a downtrend, it would be red. So what I want to show you what we can do with this prediction by using these navigation bars, and you can do this yourself after the seminar. You can go backwards and see how we predicted the prices 2 weeks into the future from the starting point of this yellow of the left-hand purple line. So we're making every prediction without the benefit of foresight, and it is not just this is a fairly sophisticated extension of the measured cycle into the future. So that's how it works on a theoretical waveform, and what I have is the ability to do any ticker in our database. We have about 5,000 stocks, and you can just put your own ticker symbol in here from our home page. It's free, and you can examine up to 20 stocks a day, including Sine if you want to play with that one. So all you've got to do is enter your stock symbol and see the prediction for yourself. So this is what it looks like on a real-world symbol. Looking at the indicators, the blue line again is our momentum line, and it's swinging with some lag relative to the movement in the price. We have the bandpass filtered cycle component, and right here at this point, for example, we have a trade setup that's caused because the cycle indicator's at a minimum, at a trough, and the momentum is declining. That defines that setup, and we got in within, well, we decided to take a trade 2 days later and got in on the open of this bar and made a 5% trade. Not every trade, here's a setup with a bar, that's a pretty good setup, but it happens that we had to get out with a loss. You know, while losing is part of trading. And back and forth. Here is a case where we did not get a setup on a cycle trough because the momentum was not declining. And similarly right here, this is a little weak cycle. Back here we have a cycle trough and a declining momentum, defining a setup, and a couple days later we got in and made a few more. And the broadness of the purple swoosh shows that although the market had been going sideways and the green indicated an uptrend, we are predicting this wave would not, well, not a buying opportunity for sure. So what we get beyond that for premium members is actual buy and sell signals, and they occur right on the last bar on the right-hand side for exercise on the next open. So that's how we use it, that combination of the bandpass filter and the stochastic-like indicator taken together with that rule cleans up the trading opportunities and cuts out a lot of the bad trades. So here's how I think is the best way to measure performance overall of a trading system. It's Monte Carlo. And the way we create the Monte Carlo results to produce this bell curve is that we take, and this is an annual performance, we take all of our trades that we have accumulated over the last 3 years, and there are several tens of thousands of these, but we draw them out of the proverbial hat, one trade at a time, until we accumulate a year's worth of trading. At that time, we note the profit, and we write that down in a database, and then we repeat that draw 5,000 more times, so that what we have done is simulate randomized trading over 5,000 years using the real data over the last 3 years. So we have the real experience with current market conditions since electronic trading began, et cetera, et cetera. We're not using ancient data based on ancient rules, but yet we've randomized it in a way that gives us the bell curve. So what that has done with the trading rules I showed you, we have gotten an annualized return of 63.3% on our 5-star rating stocks. That's our best rating. And we have a Sharpe ratio of 1.8 to 1. Notice that the S&P 500 buy and hold is about halfway down the bell curve, even though it's been a pretty good run lately over the last year. So there is a principle of statistics that if we increase the members of the ensemble by 2, we reduce the standard deviation of the bell curve by the square root of 2. So if we increase the number of the members of the ensemble by 4, we cut the deviation in half. Well, to do that, instead of randomly trading one stock at a time from our picks, we would randomly trade 4 stocks at a time. That increases by a factor of 4 the members of the ensemble. And instead of trading $10,000 on one stock at a time, we would split that 4 ways. The resultant statistically is that we have the same average profit, more or less, but we cut the deviation in half. What that means, since the Sharpe ratio is basically the average divided by the standard deviation, if we double this, if we cut the standard deviation in half, we're going to double our Sharpe ratio. And so what I'm going to show you on this next chart is exactly that. This is trading 4 randomly selected stocks from our pick at a time, and we're always in the market. This is a statistic. The old number was 63.3%, so this is a random number, but it's more or less the same. Note that our Sharpe ratio has just about doubled, and this scale on the bell curve has been changed, but you can tell that we've narrowed it down because now the S&P 500 buy and hold is way down on the skirt. Also, by reducing the standard deviation and keeping and maintaining a really good average, we've increased the probability of break even over the year to almost certainty. So that's really good. So that's this way of measuring performance using Monte Carlo by picking the random selection of the trades that you've made and running them over and over and over again in different combinations, I think is the best statistical way of showing what you can expect in the future. So what we have in conclusion is I think these are the takeaways I would like you to take with you. It's absolutely critical that the data must be properly filtered to create successful trading signals. And if you don't do that, you're going to get all of these wild rules and that are difficult to remember, and they're nonsense in the first place. So they should be based upon some statistical expectation that you're going to be profitable. Secondly, I've shown that the turning points, if you're swing trading, you must anticipate those turning points for successful short-term trading. If you wait for confirmation, you miss the bus, and you just can't play catch up. You almost have to be in a different style of trading, which is trend following, which has a lower percentage of winners. My experience is that trend trading, you have to take a lot of small bites and a lot of small losers to get the one big hit. So I prefer to go with higher probabilities of getting a winning trade. So a stock spotter it generates the trade setups. It's better than a simple momentum indicator. We're using a combination of the cycle trough produced by a bandpass filter and combination with declining or minimum momentum. And in addition to that, what I've done, because I measure the cycle activity, we can make a forecast 2 weeks into the future by extending that cycle, and that's better by far than extending a linear regression line, which is basically useless. We provide our tools free on StockSpotter, so feel free to use them. It's not day trading, but we have a large database of stocks and ETFs to be traded on a daily basis. So feel free to use our tools, and there are many more tools there than I was able to cover in this webinar. So feel free to go there and try them out. And finally, the best way to evaluate a strategy performance uses Monte Carlo analysis. Looking at equity curves is just not the way to go. I've frankly forgotten whether I mentioned it or not. I wrote that article in the the May issue of Stocks and Commodities magazine. So if you go to traders.com, I think you can download that article from them. So that is once over lightly. What I would like to do is, if you've found anything interesting to you, and I want to thank you for watching, and my thanks is extended by way of a promo code that gives you a 20% discount. The promo code is MESA4837, and nominally StockSpotter costs $75 a month. So by using the 20% discount promo code, that's cut down to $60 a month, and that goes forever. It doesn't revert to the standard rates. So with that, I would like to take questions.
Yeah,
and
thanks, John. Okay.
Okay.
So thank you, John. So guys, go ahead and type your questions, and I see a few here. I also want to remind you that when we're done with the Q&A, I'm going to give away 5 autographed copies of John's newest book. Okay, so let me see here for the first question. Lots of comments here. I'm looking for a question. Okay. Bobby wants to know if you still rely heavily on the fractal adaptive moving average, also known as FRAMA. It's like an oscillator, and weren't you the one that created that originally?
Yes, I did. The fractal adaptive moving average, that's got some whiskers on it. That's pretty old. Do I still use it? Frankly, I'm more into this indicator that I just showed you, I'm into bandpass filters, and in conjunction with the momentum taken together, they make a far more reliable entry and exit signal.
Okay. Al wants to know if your forecaster takes into account news, earnings, dividends, or anything else like that for its prediction.
No, is the short answer. However, I've been talking with my colleague Rick Way about maybe suppressing trading signals on FOMC days and triple witching days and things like that, where things go crazy. Right now, everything is taken straight away on its technical and statistical merit.
Right. Okay. Eric is asking if you have any work on the futures side. Like, I mean, I know you mentioned ETFs, like SPY could relate to the ES. Is that the best way to get a look at some of the futures, or do you support futures directly?
StockSpotter is a daily data on stocks. I trade futures myself in my private account, and I am, as I said at the beginning, I'm a principal in Mesa Vector Asset Management, and there we do exactly what I described in the webinar. We're trading ES, NQ, TF, and YM in a portfolio using the trading signals that I described for stocks. So it's using daily data, so we're swing trading the index futures.
Okay.
Those are managed accounts. I don't have a product in TradeStation or otherwise directly for use in futures, no.
Sydney is asking about the prediction tool. I think he's asking if you've gone back and measured accuracy based on what you're predicting. So, like, take a year's worth of predictions.
The question is, well, the short answer is yes. And the question is, how do you go about measuring a prediction? Are you measuring 2 days out, 5 days out? In a sense, in an overall sense, a trading system is a pretty good measure of that prediction. If you're saying, I'm going to buy on the open tomorrow, I'm expecting our nominal hold period in StockSpotter is 10 days. So you're saying, in essence, I'm predicting that the price is going to go up substantially over the next 10 days. And so by having, well, is everyone still seeing my screen?
Yes.
Okay. Here is how we performed last week, for example. We had an average profit per trade of 2.46% on 183 trades. Our profit factor is 5.1, and we had 85.8% profitable. In a sense, our results in a trading system are our prediction, or verification of our prediction, at least.
Okay.
Beyond that, in the development of this, yes, I've gone back and I've made a prediction, and I do a setback. I do it blindly. I say, okay, I've done exactly what I said. I expect the price to go up by at least 3% in the next 10 days. What's my probability of success doing that? And that's the kind of measurements I've done in assessing the prediction, the quality of the prediction.
Okay. Al is asking about your sine wave script. He says that Barry from E-mini Watch says it's a little bit off. Do you know anything about that?
Could he be more specific about why, how it's off?
I don't know.
It's simply this. In any script, it's a sine wave of 360 degrees, whether you use radian measure or not, times the current bar divided by 20, and that ticks off at the rate of 18 degrees per day, and creates a 20-bar sine wave.
Okay, I'll see if he clarifies later on in the questions. Let's see.
Okay.
Jeff is asking, he says, do you measure cycles to the center of a bandpass filter, and can you give us an update on the best algorithm for the cycle period based on your books?
Yeah. The sweet in daily data on stocks, as I said, the sweet spot is basically a 20-bar cycle, because that's a month, a nominal month in trading. And when you're setting your bandpass, in my book, I have an algorithm for in several of my books, the bandpass algorithm, which you can code up. I would set that on the short side, maybe 20%. So 16 to 18 bar cycle, you'd set that at. And the reason you set it on the short side is that that gives you the lead, a little phase lead on that monthly cycle. You know, to go beyond that, you have to measure the cycle itself and then use that in a feedback network to adjust the bandpass filter.
Okay. I see several questions about the super smoother and the roofing filter, so I'm going to try to just kind of put them all together. So first, do these work on, I mean, in your opinion, is it only stocks, or will it work equally as well on futures and Forex? And also,
yeah, I understand. These are theoretical filters. They're digital signal processing gizmos, and they work on intraday. They work on 15-minute bars. They work on equitick bars.
Okay.
They work on monthly bars, because we're dealing with sample data, and every piece of the data that we see is relative to the sample rate. Everything scales to the sample rate. And in my presentation, I tried to be careful to talk about a 20-bar cycle. And it doesn't matter whether that's a 15-minute bar or a daily bar. So in all cases, no matter what the real time frame, time base is, your Nyquist frequency is a 2-bar cycle. That is, you have to, the fastest cycle you can possibly think of in sample data is the Nyquist frequency, which is twice the sample rate, or a 2-bar cycle. And you can't use data that's close to within 2 octaves, in my judgment, because of this upper sideband is folded back down. It just swamps. It's noise on top of noise, and there's just no way to filter it out. So about the shortest kind of cycle that you can use in any time frame is an 8-bar cycle. So you can go 8 bars on out for as long as you want, 100 bars, but right. Now it gets into what is useful for trading.
Right. And I remember you went into a lot of detail on that on the last webinar for anybody that wants to get more info.
Yeah, and it's equally important on the other side of the frequency spectrum to remember spectral dilation, because if you're talking about on 15-minute bars, if you're talking about over the last hour, or the 4-bar cycle is going to be a lot smaller in amplitude. I'm sorry, the 1-hour cycle is going to be a lot smaller in amplitude than the 4 or 5 bars by a factor of 4 or 5. And so that distorts, if you're measuring cycle amplitudes, or measuring cycles in any way, you've got to remove that distortion that's in the basic spectrum itself. It's a natural phenomenon. It's in the structure of the data that it is pink noise. Okay. And so you need to put this second order high pass filter in there. Again, that's scaled on the order of the sample rate, so it works on intraday bars as well as daily bars or weekly bars.
So I remember last year, some people took the code from like the roofing filter, and I started seeing some variations on the site, on the forum. People were applying it to all kinds of different, let's call them traditional indicators. So instead of the input for the RSI or the CCI being price, the input was the roofing filter, and then of course the input for the roofing filter itself was price. I wondered if you have a comment on that. Like what is a good use of the roofing filter versus a bad use of the roofing filter?
Okay, I think you had it in linear system theory. When you can put one filter behind another, behind another, behind another, and a good use of a roofing filter is kind of like I showed my version of the stochastic. I put the roofing filter ahead of the stochastic, and then I use the output of the roofing filter. Instead of using closes to calculate the stochastic, I used the output of the roofing filter. And what that did is that let my stochastic indicator use the piece of the spectrum that I defined. That is, it went from like a 10-bar cycle at the high frequency side to maybe a 48-bar cycle at the low frequency side or the long wave side. And I restricted my analysis to that piece of the spectrum because I don't care about a 5-month cycle. I'm not trend trading. And all it's going to do is to distort my interpretation of my swing trades. And so the best use of the roofing filter is to put it ahead of any other kind of indicator that you want to use, a CCI or a MACD or stochastic, any of those. Any of the oscillators would be put it in front of any of the oscillators would be an ideal application.
Okay. Alan is asking about multiple.
There is no bad application.
Okay. Alan's asking about multiple time frames. Any comments or opinions on looking at, let's say you're trading Apple. So what about the traders that want to look at weekly charts, daily charts, 4-hour charts, 1-hour charts, 30-minute charts all together in order to find out where to enter and exit?
Sure. I have some observations. I'm a graybeard, so this is not statistical necessarily, but I'm giving you some opinion. And what I've seen is when you separate the time frame by a ratio of 4 or 5 to 1 in your sample rate. For example, if you use daily data and then weekly data, that would be a 5 to 1 separation in your sample rate. When you do that, the data are, as for all practical purposes, statistically independent. That is, you're looking at two different outcomes, and so you get an enhanced performance if you overlay them and you get, say, a buy condition out of both time frames. You're going to enhance your probability of success. I wouldn't use a 1-bar cycle and a 2-bar cycle because they're telling you the same kind of thing. Or I wouldn't use a 15-minute bar and a 5-minute bar.
Right. Okay.
Maybe a 1-minute bar and a 15-minute bar. Something, get them enough that you got some separation between the sample rates.
All right. Bob is asking for your opinion on setting stops and targets. So do you have recommendations on any tools, or do you use indicators to do this, or do you use some kind of a set rule like 2% and et cetera for setting stops and targets?
Those issues are almost psychological. Candidly, for my own trading, I don't use stops at all because I'm anticipating those turning points, and I know that since I'm anticipating, I expect some to be underwater. a lot of time before the trade turns around. And if I use a stop, the other half of that word is stop loss. And so if you hit a stop loss, it's a guaranteed loss. So I don't like losses. And statistically, yeah, I've looked at, Rick and I have looked at performance of stocks on how do they perform, and if you set a goal of 3% or so on a swing trade, you're going to come out pretty good, and take some trades that you otherwise would turn into a loss.
All right, Jeff.
There is one kind of a unique application, and that is the use of options. The holding, we in StockSpotter guarantee that you're going to be out of a trade in less than 21 days, and our typical holding time is 10 bars or 10 days. So if you, instead of buying the underlying stock from our trading selections, that you buy an in-the-money call that's a 30 to 60 days from maturity, you can use, you can consider that purchase of a call when it goes to zero. That's your stop, but you still possibly recover. You know, it could go below zero and come back and recover before expiration. So it gets a little more dicey, but you can consider trading in the money options as a stop.
Okay. As we continue the Q&A, could you bring up a chart of something like maybe SPY or something like that, just to show us?
Here's our trade setup analyzer, and just comes up on AA because I guess that's what I was looking at. That's the current view of AA. You have a symbol you like?
SPY.
SPY?
SPY. Yeah, that's fine.
Okay.
All right.
SPY. I see right now it's you want to read on current SPY?
Sure.
Is that what you're looking for?
Sure. Yeah.
Okay. In history, we had 2 setups, and because of various reasons, the swing amplitude wasn't strong enough, or the trend wasn't strong enough, we elected not to convert those trade setups to trading signals. More recently, the market mode, that is the trend, is strong compared to the cyclic activity. You can just see that there's not a lot of wiggling there. And we're looking at a forecast that is to the downside. And if we go to instead to our forecast, we see in words that we got a slightly bearish forecast. It's going to go from 193.40 to 190.20. And out here at our best guess on June 18th is going to be 191.40.
Okay. So we still got a lot of questions here, so I'm going to
here's another one. This is Raytheon I retired from. There we go. Now here we see a lot more swing activity. You see the trade setups, and I'll move that back to the setup analyzer. So it's been going pretty much sideways, but we elected not to take any of these trade setups. It looked like pretty nice setups to me. If I was just looking at the indicator, I would have taken a lot of those trades, and most of them would have been pretty successful. But right now, we're again forecasting a downturn.
All right. Jeff is asking, what's the difference between a momentum indicator and a rate of change tuned to the dominant cycle?
Okay. A momentum indicator, in my mind, is the best indication of that, or the best example of that is stochastic. It's telling you where the price is have been with some lag. So that's my definition, my loose definition of a momentum indicator. The rate of change indicator. Now, if you can think in terms of a sine wave, the rate of change of a sine wave is a minus cosine wave. That is, you're taking the difference, the rate of change of a sine wave. When it's going, I'm sorry, it's a positive cosine wave. When the rate of change of the sine wave is going through zero, that's its maximum, and that is when a cosine is at its maximum. So if you see the relationship is kind of seen by this little demonstration here. You see when the sine wave goes to its maximum, a cosine would be lagging by 90 degrees in phase. And so there's a phase relationship between the actual cyclical waveform and its rate of change. So in a sense, a rate of change indicator is a predictor. It's getting to the maximum before the actual sine waveform itself. The problem with the rate of change indicator, it's like a derivative, and you increase the noise. So to make a rate of change indicator readable, you have to smooth it, and when you smooth it, you give up all the gain, the rate of change gain, the lead that you gained. So it's tough to make a rate of change indicator to perform satisfactorily.
The Keymaster is asking if you could repeat what frequencies you set your bandpass filter to.
I'm expecting a 20-bar cycle in the stock market, and so I set the bandpass. I basically measure the cycles. That's what I do. But for somebody that doesn't have the capacity to measure them, I'd set what I expect to be the nominal cycle, which is a monthly cycle, and then I would lead that. I'd make a shorter setting by 10 or 20%. That is an 18 or 16 to 18 bar would be the setting of the bandpass filter. And the reason for that is when you set the filter a little bit on the short side, you don't lose all that.
Oh, we lost audio. John, are you still there? We have no audio from you. All right, guys, hang on just 1 second. We'll see if he comes back. I know there's still about 50 questions or so. And John, if you can hear me, we do not have audio. Can you try exiting and coming back into the webinar, or try unplugging and plugging your mic back in? Yeah, that could be. It could be that his computer crashed or something. Hang on 1 second, guys. I'm going to check my email and see if I have a phone number for him. Hang on 1 second. Okay, I do have a phone number for him. So, guys, hang on just 1 second. I'm going to give him a call. We'll see if we can get him back because I know there's a lot of questions left. So just bear with me. All right. I didn't get an answer, so what we'll do is I'm going to go ahead and move on to the quiz questions to give away the 5 autographed books. And what we'll do is that'll give us a little bit of time to see if he comes back, if he's restarting his computer or something like that. All right, so before we start the quiz questions, I want to remind everybody that I'm going to be asking for your BMT username, and that is how I will contact you if you're one of the winners of the books. So please have that ready. It's 1 book per person, and we have 5 books to give away. So the first correct answer for book number 1 will be the winner. The second correct answer for book number 2 will be the winner. And by the time we get to book number 5, I will be looking for the 5th correct answer. So that way it's not based on how fast you type or anything like that. All right. You guys are still seeing his screen, right? It's just frozen. Okay. All right. Question number 1. What noise swamps market cycles? Okay. We have the winners, so you guys can go ahead and stop. Byron T, I need your BMT username, please. And the answer is ALIASING. So let me just wait for his username. Okay, Byron, I just need your username. Okay. Question number 2, looking for the second correct answer. If a market cycle period is doubled, approximately how large is its amplitude swing? All right, guys, we got the correct answer. And the second person, John Chi, I need your BMT username, please. And the answer is doubled. So, John, I just need your username. Whoops, we just lost video, I think. Let's see. I'm just going to open my PowerPoint back up so we have video. Sorry, guys, we're full of technical issues this time. Okay, you guys see my PowerPoint? Okay, John's back. Hang on one second. Let me just turn his audio on. Hang on. We got to find him in the list. Hey, John, are you there?
I am.
All right. So what we did is we started the quiz. So let me finish the quiz if that's all right with you, and then I'd like to go back to questions. Can you do that?
Absolutely. Sure.
Okay. All right. All right. So I was waiting on somebody's username. Let me see. Okay, there it is. All right. So we're on question number 3. We're looking for the third correct answer. The market is fractal. What does Ehlers call this effect? Okay. All right, we got it. Stacy H, I need your BMT username, please. And the answer is spectral dilation. Okay, so we're on question number 4. What website provides two-week price forecasts? Okay, hang on. All right, guys, stop typing as it flies by my screen. 1, 2, 3, 4. Sebi E. Hope I'm saying that right. Sebi E. Need your BMT username, please. The answer is stockspotter.com, as you guys know. Okay, and here comes the fifth and final book. Then we'll get back to answering questions by John. All right, what is the best technique to assess trading system performance? Looking for the fifth correct answer. All right, we got it. All right, guys. 1, 2, 3, 4, 5. Bobby H. I need your BMT username, please. And the answer is Monte Carlo simulation. So just waiting for Bobby's username. All right, and I'm going to go ahead and turn things over to John while we're waiting for that. All right, Bobby, that's why I said at the beginning you got to have your username ready. So get that ready and just go log on to the site and you can see it at the top left. All right, if you don't have one, go make one real quick and then type it in before the webinar is over. Okay, all right, guys, give me 1 second, turn things back over to John. Okay, John.
Okay, sorry about that. I had a power outage here. That rarely happens.
Wow, okay. No problem. So what I'm going to do is give me 1 second to try to find where we left off on the questions because we had some pretty good ones. Just want to see if we can get a few more of those answered. Let's see. I think that you were, yeah, okay. You were talking about the frequencies that you set the bandpass filter to. And then the next question was, this is from Byron, do you have do you do any kind of analysis like a signal to noise ratio analysis to give you like a confidence level when making the cycle length measurement?
Yeah, in my Mesa package, I had a signal to noise measure, and basically, you have to define what is noise, and that's the beginning of the problem. My definition of noise would be the average daily range, high to low, because if you're making an entry, remember when I talk about daily, I mean any time frame, whatever a bar is. So the high to low range of a bar is noise on the grounds that that's below, or the sample rate is not picking up any data in any time during that bar. And so that, by definition, is noise. So if I measure the swing of a cycle component, say I filter it out using a bandpass filter, then I can measure the amplitude of the swing from its peak to its valley. And so the ratio of that peak-to-peak swing relative to the full amplitude swing of the daily range, or full bar range on the average, is signal to noise. And that was part of my Mesa package. I don't have all of those indicators in StockSpotter. I'm concentrating in StockSpotter on those signals that produce good, profitable trading signals. And the filtering that we do in StockSpotter, you saw that we have the trade setups, then we do additional filtering that are not as easily defined as they are with indicators. Things like the cycle amplitude, and it's a qualitative measure, and is in the presence of the trend, which is another qualifying. So we do what's called data mining, and we eliminate a lot of the trade setups as from being trading signals by doing that data mining. And signal to noise ratio, to the best I recall, is not one of those, but it could be.
All right, Don is asking, I think he's really asking about gaps like overnight. So he wants to know if you've done any study that shows like entering 5 minutes before the close versus entering the next day at the open, and if it would be possible to get that kind of a signal from your website instead of waiting for the next day open.
The answer is we always give signals for exercise at the market on the open, and the reason, one of the main reasons we do that is not because that's the best trading signal, but because that is a a number that we're table pounding sure of that is correct. We're always getting in at the market. We're not using limit orders or orders on the exit, 5 minutes later. It becomes, there are practical problems in doing that over the internet and the timing of it. So we're depending upon the statistics of the trade system rather than on the excellence of the entry signal itself.
Okay. Jeff,
now, I know a lot of your members are intraday traders, so I'll interject a little comment there. If you're using cycles, everyone knows that there's a pretty good amount of activity early on the first hour of the day, and so if you're looking at cycles and you have gap openings, you got a problem because that gap is going to enter into the frequency response and distort your frequency measurement. However, if you use equal volume bars, equal tick bars rather, now you because of that high volume of activity early in the day, you can get that gap opening out of your system a lot faster, and so if you're using cycles for intraday work, I would recommend looking at equal tick bars.
All right. Jeff is asking what the minimum account size is for the asset management firm, and also do you want to disclose your assets under management?
The minimum requirement is $50,000, and I'll refer, I'm the technician of this, the scientist as it were. I'd refer the business aspects to my colleague. His name is Jerry Winter. So if you go to mesavector.com, you can get the information there.
Okay. Michael wants to know if you use the center of gravity. I've seen that formula around. Do you know what that is? Have you used that?
I do.
Okay.
I do.
Isn't that one of those indicators that repaints heavily? That's what we call it in NinjaTrader. It repaints. It's I wouldn't know how to backtest it. Correct me if I'm wrong.
No, it's simply if the center of gravity is if you think of the weight of or the price as an area chart, and it has weight. If it were on a piece of paper, for example, you lay the center of gravity be 1/3 back on that triangle. It's a weight, kind of like a weighted average, and so it's taking it's a way of averaging over the all the price movements, and so it's something like a weighted moving average. It's a little bit better. However, I think that there's some phase distortion there, and it's not one of my favorites at the moment.
But
for the same kind of thing, I would highly recommend the super smoother instead.
Okay, I don't want to go too off topic, but just quickly, isn't it the type of indicator that if you're looking at it today, Thursday, and the value for yesterday is 10 that this indicator is producing? If you look at it a week from now and you come back to today, this Thursday, it's no longer 10. It's constantly changing the past. Is that right?
No.
Okay, maybe that's just a formula that I saw, because that's what made it worthless to me.
No, that's cheating, and you can't do that.
Right. Okay, let's see. Wayne is asking what the average risk percent is that you've seen in your Monte Carlo system showing the best result.
We used to show a drawdown as our risk, and our reward to risk ratio would be the expected win, or the expected profit that is at the peak of the bell curve, which would be the reward, and the risk would be the most likely drawdown number. And we were looking at numbers on the order of 4 and 5 to 1 in that ratio. We no longer display the drawdown performance results.
Ari is asking, and I know you covered this at the top of the webinar, but maybe you can just go into detail a little bit more again. He says that he's used your roofing filter to improve one of his own indicators, and he did get a better signal. However, it introduced 4 or 5 bars of lag compared to the original, and he wants to know what he can do. So, you gave an example using the stochastic of entering when it crosses above or below the threshold. What is that? Is that what you would say
right.
here?
Depending upon where he got that roofing filter, I think I used a 10 bar as the low pass filter edge as an input. If he wants to get less lag, he can cut that down at the expense of less of introducing a little more noise through the filter.
Right.
So if he cut that down to say 6 instead of 10, that would probably take out a bar or 2 of lag right there.
But there's a caveat, right? You should watch the first webinar because you went into detail about the noise, and you just talked about it here too,
Absolutely. And in my book, there's still another way to minimize noise. If technical analysis can have detrenders as a class of indicators, it could have decyclers. And so if we remove the cycle components by cancellation, that's a way of smoothing also. It's too much to go into here verbally, but it's in the book. Look for decyclers. It's removing the high frequency components by cancellation, and therefore minimizing lag.
Okay. Cliff is asking how long you hold your trades on average.
In StockSpotter, it's almost exactly 10 days.
I see a few different people asking about whether or not the source code for your indicators is available on XYZ platform. So if you go to, you can look up your books, but we also posted the code in the discussion thread for last year's webinar. So anybody that just does a search for John Ehlers webinar on BMT, you can find the original webinar and all that code, he's given away. There's no secret sauce or anything, so you could write it for whatever platform you want.
Absolutely. There are no secrets in trading. It's all in how you put the combination of things together. As one of your guys said, it improved his results, but he got a little lag, and if he can take out the lag, he'll get still better results. So it's how you take these ideas and put them together. It counts.
Jeff is asking, he says, regarding momentum, is measuring a rate of change on a Fisher transform or on the zero mean roofing filter an acceptable means of calculating momentum?
Wow. The Fisher transform is I think he's probably talking about the inverse Fisher transform, which is a kind of a soft limiter to take out the extraneous wiggles that you don't care about. And so it's very nonlinear, and taking a rate of change of that will not improve the situation for the zero crossings very much. You've got to get your rate of change done before you do that nonlinear operation. So that was one. What was the other one, Mike? Rate of change of
zero mean roofing filter.
Zero mean roofing filter. If you take a first order Hilbert transform of the zero mean roofing filter and put an AGC on that, you can get a really good rate of change. That's a lot for some. So if you take the output of the roofing filter, a first order Hilbert transform is the current roofing filter minus the roofing filter 2 bars ago. It's kind of like a 1 bar differential, except it's 2. And then and you can read in my book about how to do an automatic gain control. If you do a gain control on that to normalize the amplitude again, you'll have a really, really good rate of change indicator.
Rick is asking if you could go into more detail and define octave as how it relates to trading.
Octave relates more to the definition of DSP than to trading. An octave simply means a ratio of 2 to 1 in frequency. A 20 bar cycle is 1 octave lower in frequency than a 10 bar cycle. So it's 2 to 1 ratio. That is a mathematical ratio of the waveform that a decibel is a logarithmic measure, and so a 2 to 1 ratio is 6 decibels.
Okay. I'm just reading to the questions here. We've answered a lot of them, so I'm trying to eliminate the duplicates. Sorry, we've answered a lot of these, so I'm just skimming through.
The question of the rate of change was a good one. I don't know if everybody. I'm not trying to sell the book, but a lot of the stuff in about rate of change indicators and what I talked about, how to create it, you'll find that in the book.
So some of these questions are so incredibly technical that I think it's better if they just email you because it's too much.
Feel free. I would be delighted to answer any questions by email. Short of debugging code. I surely don't want to debug somebody else's code. It's tough enough to debug my own.
Right. Okay, so I think I'm double checking here, but I think that covers most of the questions unless there were some new ones after the Q&A. Let's see, which I don't see. Can just remind everybody, please, what is your email address if they want to get a hold of you, or what's the best way?
Okay, my email address is my last name, Ehlers. It's EHLERS at stockspotter.com. Okay. Or you can go to StockSpotter, fill this out, and it'll come to me.
Okay. All right, guys. So since we're at an hour and a half, I know that there are some more questions, but what I'd like to do is go ahead and stop here and ask you guys just to go ahead and contact John or visit his website to get your remaining questions answered. And I do want to remind everybody that you could find the original webinar, which covers the code for the super smoother and the roofing filter. You can go to YouTube, just do a search for John Ehlers webinar, and it'll be under our channel, or you can do a same search on BMT. So John, thank you as always for your time. I appreciate you coming in and talking about these things, and I really appreciate the Q&A. That's always my favorite part, personally.
Well, thanks everybody for attending, and it was my pleasure.
All right. Thanks, John. And for the 5 book winners, I will be in touch in just a couple minutes via private message, and I'll get your mailing address, and I'll ask you if you have a special autograph request, and then I'll send all that information to John. He's going to do me a favor and mail those out to you. Since I'm in Ecuador, it's not very easy for me to do that anymore. All right, guys. Thank you, John. Thanks, everybody. I'll see you on the site.
Bye for now.